The US dollar is used in 88% of every global financial transaction today. That 88% is not just a statistic sitting in an economics textbook somewhere. That 88% is why your grocery bill, your gas price, your mortgage payment exists. The dollar's global dominance is the invisible system that funds the American way of life. And on May 19, 2026, Vladimir Putin landed in Beijing to directly challenge that system. This happened less than 72 hours after Donald Trump left China on his own state visit. Trump left thinking he had stabilized the world's most important financial relationship. Putin arrived knowing the real work, the work that matters for the next century, was just beginning. Before this video goes any deeper, subscribe to Dollar Grid right now. This channel covers the financial stories that affect real American wallets every single week. Hit subscribe, because what comes next in the story will change how you see your money. Now, let's understand exactly what was agreed to and why it hits every American personally. The dollar's dominance is not some abstract privilege enjoyed only by Wall Street banks. It is the reason America can borrow money at cheaper rates than any other country on earth. It is the reason the US government has run deficits for decades without a financial collapse. It is the reason a working American's savings hold their value in a globally traded currency. When foreign central banks trust the dollar, they buy US Treasury bonds to store value. That bond demand keeps US interest rates lower, which keeps your mortgage rate lower. That bond demand keeps the US government funded, which keeps social programs running. Lose the dollar's reserve status, and every single one of those advantages begins to unwind. That is not a theory. That is basic monetary economics, confirmed by the IMF, the Federal Reserve, and the Atlantic Council. And that unwind is exactly what Putin and Xi have been constructing brick by brick for over a decade. Here is the timeline every American needs to understand, and nobody is explaining clearly. In 2014, Russia began aggressively reducing its dollar-denominated foreign reserves. Between 2013 and 2020, the Russian central bank cut its dollar reserves in half deliberately. In 2021, Putin announced Russia would completely eliminate all dollar assets from its sovereign wealth fund. That fund shifted entirely into euros, yuan, and gold, away from American financial instruments. In 2019, Russia and China signed a formal agreement to replace the dollar in bilateral trade settlements. That single 2019 agreement set the foundation for everything that followed in the years after. By 2024, China and Russia were conducting $237 billion in annual trade, almost entirely in yuan and rubles. That is $237 billion that used to touch the dollar system, and now does not touch it at all. By December 2024, Putin announced that 90% of Russia-China transactions settled in their own currencies. By November 2025, Russian Finance Minister Anton Siluanov confirmed that number had reached 98.1%, 99.1%. One of the largest bilateral trade relationships on earth, completely dollar-free. That number took 12 years of deliberate, quiet, relentless construction to reach, and Trump had absolutely no idea how far this architecture had advanced when he flew home from Beijing. Now, here is where it becomes directly personal for every American watching this video today. The dollar's share of global foreign exchange reserves was above 70% in the year 2001. According to IMF data reported by Wolf Street in early 2026, that share has dropped to 56.92%. That is a 13-point decline over 25 years. Slow, quiet, almost invisible in daily life. But 13 points on a $13 trillion global reserve pool is not a rounding error in any sense. And the speed of that decline is accelerating, not stabilizing, under the current geopolitical pressure. Here is what that decline means for the family sitting at a kitchen table in Ohio tonight. As fewer countries hold dollars in reserve, demand for U.S. Treasury bonds slowly decreases. As Treasury bond demand decreases, the U.S. government has to offer higher yields to attract buyers. Higher Treasury yields push up the 10-year rate, which pushes up the 30-year mortgage rate. The same mechanism driving your mortgage payment higher is connected to dollar reserve erosion. This is not speculation. The Atlantic Council confirmed this relationship in published economic research. Interest payments on U.S. government debt are already estimated to consume over 20% of federal revenue. That figure continues to climb as the dollar's privileged borrowing position slowly erodes over time. Now let's look at the specific weapon that Putin and Xi are building together most aggressively. The weapon is called CIPS, China's cross-border interbank payment system. Most Americans have never heard of CIPS. That is exactly why it is so dangerous right now. SWIFT is the system that currently powers almost every international bank transfer on the planet. SWIFT is also the system America weaponized when it cut Russia off from global finance in 2022. That single SWIFT exclusion of Russia taught every non-Western government the same terrifying lesson. The lesson was this: your access to global trade can be deleted by Washington with a single phone call. Every country in the global South, watched Russia get financially frozen and began drawing the same conclusion. The conclusion was that depending entirely on dollar infrastructure is a geopolitical vulnerability, not just a financial choice. China read that lesson louder and faster than anyone else and accelerated CIPS construction immediately. CIPS launched quietly in 2015 as a modest payment system with just 19 direct participant banks. By mid-2025, CIPS had grown to reach over 4,900 banking institutions across 187 countries and regions. In 2024 alone, CIPS processed $24.45 trillion in transactions, a 43% increase year on year. That growth rate is not gradual financial evolution. That is a deliberate architectural sprint away from dollars. And when Putin sat down with Xi in Beijing on May 19th, CIPS was central to their conversations. The Kremlin confirmed the two leaders discussed deepening financial cooperation and economic integration frameworks. Russia has specifically expressed interest in integrating its upcoming digital ruble with China's digital yuan. That integration would allow direct central bank to central bank transfers without any dollar intermediary involved. No SWIFT, no American oversight, no ability for Washington to freeze, sanction, or monitor the transaction. If that digital currency bridge between Russia and China goes live, it changes the financial map permanently. And it is not just Russia watching this construction with deep interest from the geopolitical sidelines. Brazil signed a formal pact in 2023 to settle China trade in yuan and reais instead of dollars. Indian refiners have already used yuan to purchase Russian oil, bypassing the dollar system entirely. Saudi Arabia, the foundation of the entire Petrodollar system, has begun pricing some oil sales in yuan. The UAE settled an entire crude oil deal with India using dirhams instead of the American dollar. The architecture that Putin and Xi signed agreements to deepen on May 19th is not sitting in isolation. It is the center of a much larger financial ecosystem that is quietly being assembled around it. And here's the part that should concern every American with money in a savings account today. The dollar's 88% share of global foreign exchange transactions is not guaranteed to stay that 88% forever. That number was above 90% just 2 decades ago, and it has been moving in one direction since. That 88% share of global transactions has been declining quietly for 2 decades. And what Putin and Xi agreed to in Beijing this week is designed to accelerate that decline. But this story goes deeper than reserve percentages and payment systems on a chart somewhere. This story has a mechanism that connects directly to what Americans pay every single month. The mechanism is something most Americans have never heard of, called the Petrodollar system. In 1974, Secretary of State Henry Kissinger cut a quiet deal with Saudi Arabia's leadership. The deal was simple. Saudi Arabia would price all oil exports exclusively in US dollars. In return, America would provide military protection and security guarantees to the kingdom. Saudi Arabia reinvested its massive oil profits directly into U.S. Treasury bonds and securities. The Treasury bond demand artificially suppressed American interest rates for 50 straight years. 50 years of cheaper mortgages, cheaper car loans, cheaper government borrowing, all of it. Every time any country on earth needed to buy oil, they first had to acquire U.S. dollars. That constant global demand for dollars is what kept the American standard of living elevated. It is what allowed the U.S. government to run deficits without the financial consequences other nations face. On June 9, 2024, Saudi Arabia let that 50-year agreement expire without renewal or replacement. No press conference, no emergency Fed meeting, no primetime coverage on American television networks. Just a quiet expiration that removed the structural foundation of 50 years of dollar privilege. Saudi Arabia can now accept Chinese yuan, euros, Indian rupees, and Japanese yen for oil sales. In 2023, China and Saudi Arabia already completed their very first yuan-denominated oil transaction together. That transaction was dismissed by many analysts as symbolic. It was not symbolic in the slightest. It was the proof of concept for a parallel oil market operating completely outside dollar infrastructure. And that parallel market is exactly the financial territory Putin and Xi were discussing in Beijing this week. According to Yaroslav Lisovlik, chief economist at the BRICS Plus research group, this is not just sanctions avoidance. He said the Russia-China financial partnership is about rewriting the rules of international trade entirely. That is not a fringe academic opinion. That is a senior economist describing official government strategy explicitly. The BRICS bloc expanded in 2024 to include Egypt, Ethiopia, Iran, Indonesia, Saudi Arabia, and the UAE. That expanded bloc now represents over 45% of global oil production and 30% of global GDP. When that coalition moves on energy pricing, trade settlement, and reserve management, the dollar feels every move. Now connect this directly to the family grocery budget, the gas station pump, and the savings account. If global oil demand for dollars declines, fewer countries need to hold dollars in reserve accounts. If fewer countries hold dollars in reserve, demand for U.S. Treasury bonds declines along with them. If Treasury bond demand declines, the U.S. government faces higher borrowing costs to attract new buyers. Those higher borrowing costs translate directly into higher interest rates across the entire American economy. Higher interest rates mean higher mortgage rates, higher credit card rates, and higher car loan rates. They also mean the federal government spends more of its budget on debt interest payments every year. Every dollar going to debt interest is a dollar not going to healthcare, infrastructure, or national defense. This is not a distant future scenario. Interest payments already consume over 20% of federal revenue. That figure is already higher than at any point in modern American financial history before right now, and it continues climbing as the structural props that have supported dollar privilege slowly erode around it. The DXY index, the dollar's benchmark against major global currencies, already fell more than 10% in early 2026. That was its biggest first-half decline since 1973, the year the original oil shock first began. When the dollar weakens by 10%, imported goods cost American consumers 10% more immediately. That cost shows up in electronics, clothing, food inputs, manufacturing components, and energy prices at the pump. American consumers have already felt the inflation pressure of the past 3 years across every category. What is coming is not a sudden dollar collapse. Nobody serious is predicting that specific scenario right now. What is coming is a gradual erosion of the privilege that has quietly subsidized the American lifestyle for decades. Here is how to think about what Putin and Xi actually set in motion this week in Beijing. They did not announce a new global reserve currency. That is still years away from becoming operational reality. What they did is deepen the infrastructure that makes the dollar increasingly optional in more and more transactions. Russia is integrating its digital ruble with China's digital yuan for direct central bank transfer capability. China's CIPS payment network already reaches 5,000 banking institutions across 190 countries as of mid-2025. That network processed $24 trillion in transactions in 2024, growing at 43% per year consistently. At that growth rate, CIPS doubles in transaction volume approximately every 24 months without slowing down. Meanwhile, central banks globally purchased 1,045 metric tons of gold in 2024, the third consecutive year above 1,000 tons. The previous annual average from 2010 to 2021 was just 473 metric tons, less than half of 2024's pace. Russia, China, India, Turkey, and Poland are systematically reducing dollar holdings and accumulating physical gold. That gold accumulation is not investment strategy. It is a calculated reserve diversification away from U.S. treasuries. Each ton of gold purchased instead of treasury bonds is one more reduction in structural dollar demand globally. Now here is the part that most financial coverage conveniently skips past when reporting on this story. Trump threatened 100% tariffs on any country trying to replace the dollar's reserve currency role. He said it publicly and directly. Replace the dollar and say goodbye to America as a trading partner. That threat carries real weight. The U.S. market is still the world's most powerful consumer economy by far. But here is what the threat cannot stop. Countries routing trade through alternative systems bilaterally. Trump cannot sanction a private transaction between a Chinese bank and a Russian energy company settled in yuan. Trump cannot force Saudi Arabia to price oil in dollars when their 50-year contractual obligation already expired. Trump cannot prevent the BRICS nations from deepening their own payment rails, settlement systems, and reserve strategies. What the Trump administration can do is slow the process, raise costs on participants, and buy America time. But buying time is only valuable if the time is used to address the underlying vulnerabilities in the dollar's position. And the underlying vulnerabilities are real, documented, and confirmed by institutions including the IMF and Brookings. The dollar remains dominant, 56.92% of global reserves, 88% of forex transactions, still number one. But number one is not the same as unchallenged. And unchallenged is what kept the American system affordable. Every American with a savings account, a mortgage, a retirement fund, or a job tied to imports needs to understand this. The architecture being built by Putin and Xi in Beijing is not designed to destroy America overnight. It is designed to slowly make the dollar optional. And optional is the beginning of the end of privilege. Subscribe to Dollar Grid right now and hit the notification bell so you never miss these breakdowns. Drop a comment below and tell us what financial topic you want Dollar Grid to break down next. This channel exists to give every American the financial intelligence that used to cost thousands of dollars to access. Subscribe, comment, share this video with someone who thinks this story is not about their wallet yet.